Hi, this is Peter from Game of Trades. There's a lot of crazy moves happening on the S&P 500 today. We're seeing some big green candles on the charts right now. What's happening? Are we going to head into a melt up? Are stocks going to start crashing? I'm here to help you navigate through this crazy market. So make sure to subscribe to this channel. If you haven't already, we post multiple videos a week. So now without further ado, let's get right into it. So this is a daily chart of the S&P 500, but we're going to dig right into an 8-hour chart to see what's going on in more detail. So I believe the last YouTube video that we made, we were still within this wedge pattern and we were about to come and test this resistance right here. So yesterday morning, I made an update on the site on Game of Trades talking about the S&P 500 testing this resistance. And I was telling them, watch for two things. Either we're going to break that level and start a melt up rally, or we're going to get rejected and revisit the bottom of the channel. So we got rejected. The S&P 500 broke down, hit that support level that we highlighted, made a retest. It went in for the retest, and it actually managed to snap back above the trend line. And then that triggered a short squeeze rally. So that's classical TA. If you're trading these short-term moves, then this is really a nice high probability trade. Seeing a breakdown, snap back into the trend line, and you're likely to see a short squeeze rally following that snapback right here. That's exactly what happened. And right now we're testing that resistance level again, and it seems like we might be breaking through and getting that blow off top that we've been expecting. Now, we don't trade these short-term moves, so we don't really care what happens, breakdown, no, not breakdown. What we care about is the high probability significant levels. So when I'm talking about significant levels, I'm talking about this consolidation here. That was one of our trades. We had a breakout backtest here. That was our entry. And so we hold our trades for, a couple weeks unless the volatility is extremely high, which recently it has not been. But even when you're only making one trade every few weeks, you need to follow the everyday price action, because when things turn south, it can happen very quickly. So we were looking at this very closely, looking at this breakdown, seeing whether it would snap back or reject. We had these support levels highlighted for people to buy the dip, right? These were dip buying opportunities. That's what I talked about in the last video. But if you have a major news event or a big breakdown on the chart, you can quickly, within just a couple days, get back under this trend line. And if you've been following this channel, this is extremely important to us. I'm going to talk about it more later in the video, but a breakdown below that stop us out immediately out of our trade, right? We don't want to be long on the S&P 500 if we're trading below that. But obviously that didn't happen, not yet anyway. We've hit our third target on our trade. And so as I said, this was a trade that we made back here, beginning of November at $35, $34 with these three targets. And we've extended a fourth target at around 3,900 points. But you can see how long ago that was. And that was one trade, and we haven't changed that position. We've booked some profits at targets, but we're not trading day to day. And yet we're still up so far 7% on that trade. What's the average annual return of the S&P 500? It's around 7%. So we've managed to get that off one trade in just a couple weeks. That's swing trading, very different to day trading. And I think it's very important for everyone to understand that when you're looking at our videos. That's our trading style. So we're really paying attention to just a few significant levels that either make us bullish or bearish. And this was one of these levels that I'm going to talk to you about a little bit more in this video. But the breakout above this line right here was the beginning of the end of the bull market. And that's when you get the most gains. That's when you get that melt up and those massive returns. And that's something you can trade, but you can't invest in it, because in our opinion, there's just too much risk. And there's other asset classes where you're going to be a lot more profitable, like gold and like crypto and like cryptocurrencies that have been absolutely exploding recently. So that is very nice to see. So if you're interested in knowing more about our long-term capital investment thesis and what kind of opportunities we're looking at long-term other than the stock market, make sure to go check out our website at gameoftrades.net. And as I just mentioned, we also post trade ideas on swing trades on the S&P 500 stocks. We had trades on Tesla. We recently completed a nice trade on Tesla with quite a few targets, as well as Apple that just hit its all-time high. That was also a nice target of ours. So back to the S&P 500, how can we now benefit from the stock market? How can you position following this move right now? And so that's exactly what I'm going to talk about in this video. And I want to say right off the bat, you don't chase this kind of a move. If you're not yet positioned on the S&P 500, this is not the best entry, right? We're testing that resistance. Maybe we'll break out. Maybe that will be a nice entry. Although that would be very aggressive, it could be a nice entry. But generally, we don't like to position on the S&P 500 after such a big rally. So don't worry, there's going to be more opportunities on the stock market. I don't think it's worth chasing that FOMO, because that's exactly what traps people at the top, chasing that FOMO. It's much better to stay on the sidelines for a while, watch what happens, and strike when you're absolutely 100% sure that your trade is going to play out. By the way, make sure to like this video if you haven't already. It really helps out our channel. Just a couple seconds to click that like button, and it really gives a boost to our videos and makes our effort worthwhile. So thank you very much for doing that. Now let's move on, and we're going to take a look at the MACD on this chart, and we're going to take a look at the daily chart. This is where most traders follow what's going on in the MACD, and you can potentially take advantage of what's going on. And you can see right now, this is what we've been talking about for a couple weeks. We're getting a bullish crossover on the MACD. And I know I've said this a couple times. We tried to cross over here once. We tried to cross over here twice, and both of those times it got rejected, right? So it broke down that minor trend line once, twice, but both times it snapped back above it. So there's a lot of buying power here, and the markets are really telling us they want to take this higher. And so the MACD is crossing over now, and potentially we're going to get that momentum switch that we've been talking about and getting that uptrend acceleration. And I do believe that we're one of the only channels that have been talking about this uptrend accelerating, right? Nobody's talking about that. Everyone's pointing out the divergence and the fact that we should be breaking down, that we're heading too high. And this is bullish. Very similar to how this was very bullish right here. We had that crossover. If you're positioned long on the S&P 500 here, you can book profits along the way on that blow off top. Same thing here. We had that crossover, and you can book profits along the way as the uptrend is accelerating. Again, same thing here, that bear trap, bearish crossover, and then bullish crossover. You get that blow off top. Nothing is 100% in the markets, right? We'll see how the S&P 500 reacts to that level here, this trend line. But if these gains continue and they don't fade this week, then we might actually see a blow off top scenario similar to previous instances. And that's exactly why we extended our trade with a fourth target to potentially take advantage of that kind of a move. But again, if you're not positioned into the S&P 500 just yet, it's not worth it. It's not worth chasing this breakout for a 2.5% gain. The risk is definitely to the downside. Now for us, as I said, we're already up over 7% on our trade, and we've booked profits at target 1, we've booked profits at target 2, and now target 3. And so holding for just a few more percentage points is not that big of a deal for us. So don't chase the FOMO. You're going to get more opportunities. That's what we're here for. Subscribe and hit that notification bell so that you don't miss any of our videos. Now, another thing that I want to talk about is the put call ratio, just giving you guys another reason not to FOMO into this rally. However tempting it may be, the put call ratio is extremely low. Now, as we've said, right, this is not a sell signal on its own, but it does tell you that there's risk in the market. Now, it was really fascinating seeing the put call ratio stay so low for so long. It really shows you the change in sentiment that we're seeing in the stock market. A lot more complacency, a lot more greed. Any other time of the year, I would have told you with this kind of reading, I would have told you sell, book your profits, right? This never happens. You never get these kinds of readings on the put call ratio. That's what a rational trader would have done, but this is not a rational market. You need to adapt to the market that we're seeing right now. And the fact of the matter is that the market is complacent. And so we're going to see these put call ratios get extreme more and more until we have that flip. So don't buy into the stock market when it's low, but also doesn't necessarily mean you should sell. I mean, look at these readings. These were not good sell signals by any means. Now I want to move on and take a look at 2008, take a look at the price action that was happening back then on the SPX, because we really believe that taking a look at history really helps you navigate through the current market, right? There's no better way than to look at history to predict the future. History often rhymes, it often repeats itself, not exactly, but very, very similar. So again, for us, it's all about this trend line here in 2020. We've broken, telling us that the quote unquote normal gains that we've seen throughout the bull market are now going to be outperformed, at least in the short term. And so it really seems like the stock market is disconnected from reality. And that's really been a theme over the past few months with this rally. You know, things are not going well in the economy, and yet the stock market is heading on to all-time highs and in a very aggressive manner. That doesn't make sense. And yet it does make complete sense, because that's exactly what happens again and again throughout history. Let's take a look at 2008. So this is 2008, the bull market from 2003 to 2007, and then the 2008 crash. And I've highlighted this trend line for you. We've talked about this on videos before, but I just want to show you exactly the timing of events and when things started to look ugly in the economy and what the stock market was doing at that time. So you can see right here in 2006, leading up to 2007, you had this huge breakout on the stock market, right? So by the looks of it, the economy is doing very well. You've got no problems. You're accelerating the uptrend, and it's almost hard to see because it really shows you how perverted the game is. This type of move is designed to get everyone on board in the stock market at the very top, because this is exactly the type of move that gets sentiment to be extremely optimistic. And that's something we see time and time again throughout history. Bull markets end when optimism is extreme, when most people are optimistic about the stock market. So that does look quite similar to what's going on in 2020, but you could argue that back in 2006, we weren't seeing global shutdowns due to a health crisis, which is true. But I'll give you a counter argument, and that is that the housing bubble actually topped in 2005, and home prices went down significantly throughout that period. And I'm going to show you exactly what I'm talking about. We're going to put a home builders ETF here, RUF. And so you can see this was the big housing bubble all the way to 2005, topped in 2005, and it came down significantly throughout these years. So as the stock market is making all-time highs, right here it was making all-time highs, it topped right there. The housing bubble was already down 50%, right? So home prices were down significantly from the highs. That's not a sign of a good economy. That has massive implications for the average person. And yet the stock market was continuing on higher. So that's just to show you the stock market can stay disconnected from reality for a significant period of time. Now, I'm not even saying that we're going to see a 2008-like crash. We could. That's definitely a risk, and we think that's definitely a possibility if the policymakers make some mistakes in the coming months. But again, the current market is definitely at high risk, and the stock market in general is unlikely to perform as well as it has over the past 10, 15 years, despite what the charts are telling us. From a fundamental standpoint, it doesn't stick. So again, if you're interested in our investments outside the stock market, make sure to go check out gameoftrades.net. We've recently posted an article on Bitcoin's possible double bubble cycle that we're seeing and how we're going to adapt to that. We're going to be making more updates on this, as well as the long-term gold cycle, some targets for 2024. We tell you when we're setting our buy orders, talk about news, talk about what's going on in the economy, IPOs, commodities, emerging markets. So if you're interested in all that, make sure to go check it out. Now that's about all I wanted to cover in this video. If you enjoyed, make sure to drop a like and subscribe if you haven't already. In the meantime, good luck on your trading and see you next time.
So, you want to invest in the cryptocurrency market, but you don't know where to start? Welcome to the Covesting module on PrimeXBT. The Covesting module helps investors and talented cryptocurrency traders find each other. With an easy-to-use interface, you can compare and replicate successful strategies with a proven track record. You can follow multiple trading strategies to diversify your risk. Covesting module on PrimeXBT. They trade, you profit.